Greetings, friends and fellow economic enthusiasts. Today, we're diving into a looming economic storm that's brewing in one of the world's historically most fascinating economies, Japan. Now, as you would expect, in Japan, when central bank bigwigs make decisions, the world economy feels the tremor. And today, we're talking about how Bank of Japan, BOJ, Governor Kazuo Ueda seems poised to steer the country towards an unprecedented monetary tightening in December, the first time Japan would raise the benchmark interest rate 3 times within a single year since 1989. The era of Japan's economic bubble. For those of you who've been following along for a while, you know that the BOJ has been notorious for keeping interest rates absurdly low, almost scraping negative territory, for years. You may be asking yourself, why is this news so globally important? Well, let's unravel this waist-deep mess filled with complex economic, political, and increasingly jaw-dropping dynamics. Governor Ueda has repeatedly said that the Bank of Japan will raise rates in December if the economy performs in line with projections. And by the looks of it, the data emerging from Japan's machinery of monetary policy is increasingly supportive of such a decision. We're talking rising wages, bullish corporate investment, and inflation that refuses to go away. Now, the prospect of a rate hike isn't in doubt, but the timing certainly is. Everyone, from traders to institutional economists, is reading the tea leaves ahead of the BOJ's big December 19th meeting. Yet, the stench of uncertainty still looms large. What's certain is this: the next interest rate hike could shake global financial markets and might, just might, spark a new era of challenges for the Japanese economy. First off, let's grapple with the bigger picture here. Japan's economy ain't exactly sprinting like Usain Bolt anymore, and it hasn't been for a long time. Gone are the days in the late 1980s and early 1990s, when Japan was the major challenger to US economic supremacy. Now, Japan is aging, rapidly. No new kids buying houses, no new labor force to drive innovation, and no easy solutions in sight. In economic terms, Japan has long sailed past its mainstream growth years. According to recent estimates, nearly 30% of the population is over 65 years old. Some quotes even say Japan is hitting peak elderly, with a declining birth rate that's like watching a slow-motion train wreck. And yet, Ueda has finally ended Japan's grand monetary experiment earlier this year, by jacking up rates for the first time in 17 years. That's a huge deal, folks. They'd been trying radical monetary easing measures ever since Prime Minister Shinzo Abe and the BOJ of the time launched the infamous Abenomics policy in 2013, throwing cash at the economy in a bid to rescue Japan from nearly 2 decades of stagnant hyperdeflation. But now, we're in a brand new chapter. In 2024, Ueda is taking a step in the opposite direction, firmly rejecting radical quantitative easing strategies, i.e., printing flushes of cash in a desperate attempt to get people spending. But hold on to that thought, because while this all sounds like Japan is riding into the sunset to fix their economy once and for all, there are some very messy implications and contradictions simmering underneath. Let's be crystal clear about inflation in Japan. Its presence hasn't been as persistent or damaging as it was in the West. In fact, Japan was in desperate need of inflation for the longest time after battling 2 lost decades, the 1990s, followed by the 2000s, where prices stagnated and even continuously fell year after year. These 2 decades of prolonged stagnation are why inflation holds a distinct narrative in Japan. Unlike nations battling runaway inflation, hello, Argentina, Japan has had the opposite problem. Its attempt to revive inflation via loose monetary policy is akin to throwing a bungee cord at a boulder in hopes it pulls it uphill. Something had to give. In recent months, finally, prices have started ticking up. Now, price dynamics in 2024 finally show sustained momentum. That's encouraging in some senses, but Japan's inflation still isn't rocketing out of control like it is elsewhere. It's barely within the central bank's target range of 2%. Persistently low wages have been the critical barrier to this long-desired cycle. Still, Japan's wage talks have finally shown something remarkable: the possibility of real wage growth. If legitimate wage growth happens, Japan could step into a virtuous wage price cycle, where rising prices prompt workers to demand higher wages, and those higher wages lead to greater spending and thus sustained economic growth, the magic formula every central banker fawns over. But here's where the tension sets in. The wage talks, while showing signs of worker bargaining power, must go hand in hand with a corresponding productivity surge. That's where Japan is incredibly vulnerable. Let's add some numbers here. Data from the IMF shows that labor productivity in Japan is among the lowest of the G7 countries, and the productivity growth rate has remained sluggish for years. This means, even if wages rise, businesses, particularly export-reliant manufacturers, might struggle to absorb the cost without raising product prices significantly. So, that means inflation could spiral without commensurate productivity growth. In other words, what Ueda and company are aiming for, a delicate balance, might actually careen off course. Now, let's spice things up a bit and talk global. As if dealing with these domestic uncertainties wasn't enough, Ueda is doing a balancing act on a global financial tightrope, with the ever-watchful eyes of U.S. Federal Reserve Chair Jerome Powell staring back at him. Let's break this down. Just a few hours before BOJ's board sits for their decisive meeting, the Federal Reserve will be announcing their own interest rate decision. And guess what? If the Fed continues its tightening policy, albeit they're slowing down on the hikes lately, and Japan doesn't move in lockstep, we're staring at a divergence between American and Japanese interest rates. You know what comes next, right? Rapid yen depreciation. You see, over the years, Japan's famously low rates have positioned the yen as a major funding currency in global carry trades. Investors gobbled up cheap yen-denominated loans to invest in higher-yielding assets elsewhere, profiting from the stark contrast in borrowing costs. Data shows that Japan's net foreign investments, as of 2023, exceed $3 trillion, indicating a strong inclination toward hefty global outflows. But a hawkish turn from the Fed, coupled with more cautious moves from the BOJ, would essentially create a situation where the yen weakens further. Investors would flee, looking for more attractive interest-bearing assets elsewhere. Remember, the yen is already one of the weakest performing G7 currencies this year. And what about political roadblocks? Well, this is where things truly get tricky. New Prime Minister Shigeru Ishiba seems to be walking on a knife's edge with his coalition. Recently, his government encountered its worst electoral performance since 2009, losing its majority in the Japanese Diet. Against such shaky political footing, Ishiba finds himself in desperate need of leveraging the opposition to help pass crucial laws and budgets, specifically a 14 trillion yen, $93 billion, extra budget package to stimulate growth. As economics and politics often go hand in hand, a government on crutches can drastically limit what monetary authorities are willing to pull off. The timing of Governor Ueda's decision couldn't possibly be any worse. Political factors could potentially influence the BOJ's decision to delay a second rate hike until January, as certain economists speculate. If Prime Minister Ishiba's coalition becomes too unstable ahead of the December decision, questions on how effectively he can maneuver fiscal policy to prevent an economic downturn will intensify. Let's fast forward back to history. The last time Japan enacted 3 rate hikes within a single calendar year was back in 1989, just before the bubble burst spectacularly. The Nikkei 225 stock index hit its all-time high in December 1989, just at the same time BOJ seemed diligent about stemming runaway growth. As soon as the recession sucked the confidence out of investors, Japan's long economic winter began. Today, of course, we're in a vastly different world. Japan isn't on the cusp of becoming the world's dominant economy like it was back then. The financial landscape is different, with globalization, tech adoption, and international competition defining the rewired scope of policy dynamics. But the weight of history casts a long shadow. Current bond market behavior shows a telling recognition that significant hikes could recalibrate economic forecasts altogether. Japan's 2-year bond yields, which now sit at their highest since 2008, are pricing in the upcoming changes Ueda is hinting at. Yet the fear of a repeat of the early 1990s still looms for many investors. Remember, we live in a highly interconnected financial system today, much more integrated than we did during previous financial crises. If Japan raises rates beyond expectations come December, it could push market volatility to new heights and spur interest rate spillovers in other regions. Global markets remain in a tense standoff. With the Federal Reserve, the European Central Bank, ECB, Bank of England, BOE, and even the People's Bank of China, PBOC, all grappling with their own sets of unique challenges, including slowing growth and persistently sticky inflation, Japan's monetary moves have far-reaching implications. But economic tremors in Tokyo, where Ueda is poised to raise rates once again, could very well send ripple effects across the globe. Let's dive into the broader implications and see how this decision may spill over to the wider financial landscape. As mentioned, a key worry for markets is how Japan's hesitation or measured rate hikes might lead to further yen depreciation. With the Fed possibly holding its high rates, and BOJ inching forward cautiously, the expectation among currency traders is clear: if the interest rate differential widens between the US and Japan, the yen will continue its downward trajectory. This matters because a weak yen brings both opportunities and risks. Now, a depreciating yen historically boosts Japan's exporters, making made-in-Japan products cheaper on international markets. We've seen the benefits play out for Japan's corporate titans, Toyota, Sony, and Mitsubishi Heavy Industries, just to name a few. Indeed, in the past, a weak yen has long been a policy lever that Japan has pulled to stoke the competitive advantage of its mighty industrial sector. However, here's the twist: the benefit of a cheap yen may no longer be the magic potion it once was. After years of aggressive globalization and shifts in international manufacturing hubs, Japan's reliance on exports to fuel economic growth is no longer as secure. Even worse, input costs, such as energy prices, are notorious trouble spots for Japan's import-dependent economy. With oil and gas prices still at elevated levels, a weak yen makes importing critical energy resources more expensive, exacerbating inflationary pressures at home. While a weaker yen benefits exporters, it also accelerates costs for import-heavy industries and, most importantly, consumers. Japan imports a vast percentage of its energy, food, and raw materials. As the yen continues to weaken, Japanese households face inflation that's increasingly difficult to manage, especially when wages, despite their recent pickup, are not growing fast enough to compensate for rising living costs. A significant uptick in inflation could erode disposable income and jeopardize domestic consumption, the other crucial pillar of economic growth. Let's dig into the numbers. With Japan historically importing more than 90% of its energy requirements, the yen's weakness would inflate energy costs further when Japan is already grappling with tepid demand and higher global energy prices. According to data by the Ministry of Finance Japan, import costs through 2023 surged by over 35% in nominal terms, predominantly because of yen depreciation in addition to global price hikes. Given these rising costs, the central bank's decision becomes a double-edged sword. If BOJ does act and raise rates, they may stabilize the yen but at the cost of slowing down growth and sparking instability in an already weak wage economic feedback loop. In this increasingly globalized economy, central banks do not operate in isolation. Any move by the BOJ will be closely watched and reacted to by financial markets worldwide, particularly in the United States. The Federal Reserve holds substantial sway when it comes to influencing global interest rate trends. Should Ueda proceed with increasing rates, the BOJ and the Fed's actions will be viewed side by side by investors from Tokyo to New York. If the Fed opts to keep rates high or signal any further hikes, as market expectations maintain a slim but definite probability of, it would create an even wider divergence from Japan's new but still relatively low rates of just 0.5%, even after multiple hikes by the BOJ. This dovish-hawkish dynamic sets the stage for complex market reactions. More importantly, it could place intensifying pressure on Japan's currency, further driving yen weakness and sparking massive forex volatility. We've already seen speculative movement in financial markets. Currency traders have been increasing their short positions on the yen, betting that the divergence between US and Japanese rates will result in continued currency depreciation. Bloomberg data shows yen market volatility recently reached a 5-year peak, with more investors using derivatives, such as options and forward contracts, to hedge against further currency slippage. Even more troubling is the possibility of US funds flowing into Japanese equities and bonds upon a more substantial yen weakening. While foreign inflows into Japan's market, notably the Nikkei and Topix indices, generally prop up equity valuations, too much speculative inflows could trigger market bubbles, akin to the overheated run seen in late August when volatility spread alarmingly across markets after Japan's last rate hike. While we've talked about the political and trading landscape, let's take a moment to focus on how these developments trickle down to the common Japanese household. This is the real battleground as we assess whether the country can successfully break out of its multi-decade-long economic inertia. Here's something that merits deep concern. Despite the convincing rise in wages, real incomes in Japan, adjusted for inflation, have stagnated, if not slightly fallen. According to data from Japan's Ministry of Internal Affairs and Communications, September 2024 saw household real incomes drop by 1.8% year-on-year. This is devastating for an economy that hinges on domestic spending. Sure, wage negotiations from spring showed some promise, and the annual wage gains from major firms are notable, averaging over 3.5%. However, when inflation slices away at family budgets, any wage gains become nullified. With household debt-to-income ratios creeping up and living expenses further strained by increasing import costs, we're witnessing a tightening squeeze on Japanese living standards. Families are increasingly reluctant to spend, which hampers the BOJ's objective of sparking robust consumer demand. And here lies the kicker: if the BOJ continues focusing purely on macro-level inflation indicators, there's a real chance they misinterpret the reality on the ground, rising costs with little perceived improvement in living standards. While we've covered the critical issues at the macroeconomic and household levels, one more element throws a wrench into the machinery: politics. Japan's Prime Minister Shigeru Ishiba is running a fragile government, and this could prove to be a serious hurdle for Governor Ueda. What are the political constraints, and could they delay the BOJ's decision-making process? Shigeru Ishiba's hold on power has slipped considerably. The October 2023 election saw his ruling coalition lose its majority, representing the biggest electoral blow to the Liberal Democratic Party, LDP, since 2009. This situation forces Ishiba to seek cooperation from opposition parties to pass an emergency 14 trillion yen, $93 billion, stimulus package aimed at boosting the economy. Now, you may ask, is fiscal policy and monetary policy truly separate in this case? The reality is, despite the BOJ's stated independence, it tends to face implicit political ramifications depending on the government situation. If Ueda delivers a rate hike in December and markets react negatively, leading to temporary downturns in equity markets or destabilized bond prices, this will reflect poorly on the government. The extra stimulus that Ishiba needs to pass could then become a thorny political issue. Economists like those from BNP Paribas have flagged this issue, suggesting that there's a chance the BOJ delays its December rate hike if political instability intensifies. Indeed, Ishiba must walk a perilous tightrope. He's tasked with both stabilizing an economy wrestling with multiple headwinds and navigating the contentious battlefield of political compromises. Any disruptive reaction from BOJ decisions could embolden the opposition and splinter his fragile coalition further. This situation calls into question whether the BOJ can or should afford to make its decisions purely on the basis of economic data alone, or whether, in practice, the political constraints might weigh too heavily. After all, any major economic missteps at this juncture could lead to a political reshuffling that further disrupts policy continuity. The upcoming December decision will reverberate beyond Japan. Why? Because we are living in a profoundly interconnected financial world, where shifts in one major economy can instigate spillover effects in others. There are three main channels through which Japan's rate hikes could affect global markets. 1. Capital flows and emerging markets. The divergence between BOJ's rising rates and persistent low rates in other parts of the world could lead to instability in emerging markets. Japan is a major source of outward portfolio investment, meaning that many Japanese funds are placed in foreign markets. However, as Japan's interest rates begin to rise, there could be significant capital flow reversals, particularly in debt markets. Already, we're seeing distress signals among some emerging market bonds, many of which are finding it hard to cope with rising global interest rates. If Japanese investors pull capital back home either due to higher domestic yields or forex turbulence, emerging markets risk seeing further financial instability, especially those reliant on external funding. Countries such as Indonesia, Brazil, and Turkey, already burdened by high levels of debt, could find themselves at the center of a liquidity storm. 2. Equity market volatility in the US and Europe. The second significant spillover risk from any aggressive BOJ rate hike is the trigger it could pull on equity markets globally, particularly in the US and Europe. Let's not forget that Japanese investors are massive players in global equity markets. Over the years, Japan's ultra-low interest rates have encouraged domestic investors to look for higher returns abroad, with trillions of yen flowing into US stocks and European equities. If the BOJ tightens its monetary policy aggressively or faster than expected, investors could repatriate their funds. Why take risks investing in US equities or European bonds when Japanese yields finally start to offer a reasonable return, albeit still low by global standards? A sudden reversal in capital flows would likely hurt US equities, especially the tech-heavy Nasdaq, which has soared thanks to low interest rate environments, both domestically and internationally. European stocks, already fragile due to a slowing economy in the Eurozone and lingering inflation concerns, could face heightened volatility if Japan pulls back its capital flows. It doesn't help that global markets are already jittery. Constant fears surrounding higher interest rates, the persistence of inflation in Europe, and concerns over a potential US recession in light of the ongoing monetary tightening efforts by the Fed will only amplify the market's sensitivity to external shocks. The BOJ's potential exit from decades of unconventional policies could act as a catalyst for dramatic corrections in these markets. 3. Bond market turbulence and global yield shifts. When examining the bond markets, Japan again holds significance. Japanese investors have been heavy buyers of foreign government bonds for years. These buyers, including Japan's gigantic pension funds and insurance companies, help suppress global bond yields, particularly in countries like the US, where Japanese funds help meet the constant demand for treasuries. As BOJ rates rise, even if only to 0.5%, the opportunity cost of keeping money in foreign bonds increases. This scenario could cause a sharp drop in demand for foreign bonds, increasing yields in other economies, potentially pushing borrowing costs higher worldwide. Japanese government bond yields would likewise adjust, leading to upward pressures on global yields. The yen carry trade, in which investors borrow funds in yen and invest in higher-yielding assets abroad, could also dramatically unwind if Japanese rates inch even modestly higher. This rotation could exert upward pressure on bond yields globally and potentially squeeze liquidity in already tight bond markets. This could be particularly dangerous in regions like the Eurozone, where an economic slowdown seems imminent, and inflationary pressures continue to weigh on government budgets. Higher bond yields combined with weakening demand for debt could put even developed economies in precarious positions. We must remember that Japan is the second largest foreign holder of U.S. Treasury bonds. According to U.S. Treasury data from 2023, Japan holds more than $1.1 trillion in U.S. Treasuries. Any shift in this dynamic could have massive implications for interest rates, liquidity, and fiscal policy, especially for an America that's consistently running exploding budget deficits. In short, the BOJ's decision will likely trigger adjustments in global bond markets and steepens the yield curves across economies whose bond markets are susceptible to Japanese capital flight. Beyond the immediate financial markets, Ueda's decision also lays bare a deeper, more existential challenge for Japan. The country is grappling with a demographic crisis where an aging population and a shrinking workforce are testing economic sustainability. The broader concerns aren't simply about whether Ueda will raise rates in December or January but whether Japan can truly create a thriving, inflationary economy despite these monumental challenges. Japan's population dynamics are the starkest in the developed world. According to data from the Japanese Ministry of Internal Affairs, by 2023, 29% of Japan's population is aged 65 or older. This ratio will only accelerate as the birth rate continues to collapse. The country's fertility rate now stands at 1.3 births per woman, far below the replacement rate of 2.1. That means Japan is currently losing approximately 500,000 people every year, and that number is on track to rise steeply. The consequences for economic growth are severe. Fewer workers means lower potential output, declining consumption, as retirees spend less, and increasing social security burdens on the remaining workforce. This puts the BOJ's mission in a uniquely complex bind. Typically, central banks fight inflation by raising rates and employ loose policies during recessions to spur growth. But what if an economy faces structural aging challenges that standard monetary policies can't address? This is the key conundrum Ueda is facing. There is excitement surrounding Japan's improving inflation dynamics in 2024, with economists pointing to wage increases and sustained inflation of 3%, finally breaking the back of nearly 2 decades of deflation. But the question remains, is this sustainable? Japan's previous approaches to stimulate the economy using radical monetary action, including quantitative easing and negative interest rates, failed to create the long-sought-after inflationary cycle. Part of the problem is consumer psychology. Decades of low inflation conditioned Japanese consumers to delay big purchases, believing that prices will always remain low. Rising wages and prices take time to change deeply ingrained behavior. Japanese households are still hesitant to spend too liberally despite higher wages. More than 60% of the recent wage increases were set aside in savings, not spent. Here's the worry: while sustained inflation momentum may help Japan, it might not be enough to spark genuine growth. Productivity remains an enormous issue. Japanese productivity per worker is still lagging well behind its peers. Japan ranks 26th among OECD nations in measured productivity output per hour, according to the OECD's latest data. Adding to the complexity, Japan continues to resist large-scale immigration, which many economists argue could be essential to maintaining its labor force and ensuring economic vibrancy. Unlike in Europe or the US, Japan's landmass, cultural identity, and political landscape make large-scale immigration politically unpopular and logistically challenging. Without a meaningful influx of workers, Japan has no easy demographic solution. Robotics and artificial intelligence are often touted as the future of Japan's workforce, but such technological transitions are slow-moving and could be inadequate to solve a crisis whose impacts are felt now. One of the only viable solutions to Japan's labor shortage is to revolutionize its work culture, particularly by encouraging more women to join the workforce. Despite rising labor participation by Japanese women in recent years, the country still ranks far below other developed nations in gender equality and female workforce participation, with cultural norms often keeping women out of higher-paying, full-time positions. Breakthroughs here would be one of the most potent drivers of growth in the long term, but so far, the government has been slow to effect meaningful change. As Governor Kazuo Ueda prepares for the critical BOJ policy meeting in December, it's becoming increasingly clear that his decision could have vast implications not only for Japan's domestic economy but also for global financial markets and investment sentiments in currencies, equities, and bonds. The tug-of-war between natural long-term inflationary momentum in Japan and the lingering effects of an aging population, structural stagnation, and low productivity highlights the precarious balance that the BOJ must strike to ensure sustainable growth. At home, BOJ rate hikes could significantly impact consumers, and despite wage increases, real household purchasing power remains fragile. Japan's ability to navigate global market dynamics vis-a-vis Fed moves could generate volatility across currency and bond markets, adding pressures to a global economy already vulnerable to shocks. Meanwhile, internationally, a BOJ rate increase could accelerate yen-carry trade unwinding, disturb capital flows, and push global yields higher, exacerbating ongoing market volatility in the US and Europe. Ueda and the BOJ board walk a fine line. Too assertive a rate hike could create financial instability and hurt Japanese businesses and households. Too cautious, and the opportunity for true economic normalization may slip through Japan's fingers once more. It's certain that market watchers worldwide are highly anticipating December's BOJ decision. Whatever direction it takes, this move will likely determine whether Japan is steering toward an era of stability and cautious optimism, or risks repeating the cautionary tale of its lost decades.